It's November 14th, 2025 in Toronto. We've had our first snowfall of the year. Ugh. I was at a men's national soccer team game last night, and it was cold. Those poor players from Ecuador, I'm sure, had quite a shock. The first snowfall, that means winter's coming, and it means we need to start thinking about our outlook for markets in 2026. This week, we started a deep dive into what we see coming in 2026 and how to position our portfolios. So here we go. Overall, equity allocation, neutral. There's lots of political, geopolitical risks out there, so we want to stay neutral with our equity allocation. Specifically, in the United States, we just had third quarter earnings in the United States. The earnings were good. In fact, the forecast for 2026 is good. So there's a lot of tailwinds from corporate earnings in 2026 in the United States. At the same time, by many measures, valuations there are high. And if you pay too much for your stocks, that could have a negative impact on returns, at least in the short term. Also, we've heard about this many, many times. The concentration of the Mag 7 stocks in the market in the US signifies some vulnerability, some risk in the market. So for those reasons, we're neutral, our exposure to US stocks. What about Canada? Well, we seem to have really moved past those trade shocks from early 2025. At the same time, what's going on in the real estate market in Canada, a really significant part of our overall economy, makes us a bit nervous about the outlook for Canada. So we're staying neutral in our exposure in Canada. Where we do see an increase, where we're considering adding positions, are the international markets, like Europe and Japan, where the valuations are a little less stretched. So that's stocks. What about that low risk portion of your portfolio? Well, in the low risk portion of your portfolio, we're dividing between bonds, importantly, short-term bonds. What does short-term mean? Kind of 1 to 3 years, 1 to 7 year bond durations. We also want to be sure to have some cash, not too much cash. We're not running for the hills here. We just want to have some cash available and alternative investments. See, those three things, that part of your low risk portfolio, really is there to accomplish two things. Number one, keep portfolio volatility low when the feathers do hit the fan. But secondly, give you some dry powder to opportunistically take advantage of the fact that prices go lower. So that's the low risk part of the portfolio. Short bonds, cash, alternative investments. We are definitely making changes based on what happened in 2025 and what we see coming in 2026. Have you made any changes? Have you reviewed your asset mix or changed it in the last 3 to 6 months? If you haven't, I'd say it's time. And you don't have to do it alone. We are happy to share our asset mix research with you. Just send us an email, we'll forward it along, or call. We can help.